This is Colin Cattell with Palisade Radio. Here on the line with us today is returning guest Rick Rule. Rick, last time we had you on the program, over 6,000 listeners tuned in to hear your outlook for the market and gain insight into investing in the junior space. So thank you for taking the time to join us once again.
Well, Colin, it's a pleasure to speak to your listeners. I enjoy it.
I want to start this interview out by looking back in time at some of the life experiences that have shaped you into one of the top speculators in the world for precious metals. I've heard bits and pieces of this story in previous interviews, but I haven't gotten a full account. I understand you started out as a bouncer in Vancouver back in the 70s. How did things evolve from there?
Well, I'm tempted to say that I got a lot of degrees from the School of Hard Knocks, which is the way that most people get them. It's true that I started my career in Vancouver as a bouncer. That was not a career aspiration. I was, like millions of people before me, an immigrant, and I came to a country, Canada, to pursue an education at the University of British Columbia. The only transferable skill I had at age 18 was the fact that I was fairly large, and I'd boxed for 10 years, which did give me one marketable skill. It was not a wonderful career choice, but it was useful for the time and place that I found myself in, and it interestingly led me through a rather circuitous path to owning food and beverage establishments in Vancouver. In other words, it led me to be an entrepreneur at an early age and learn something about business. And in fact, led to the capital formation that allowed me to become a resource investor and speculator in the middle part of the decade of the 1970s.
Many wealthy people have told me that to become truly wealthy, one must lose all their money at least one time. And from what I understand, you kind of ran into an issue back in the last bull run in gold. How did you come out of that and bounce back to where you are today?
That's absolutely true. In the first bull market that I participated in, which was the spectacular 1970s bull market, I was very well placed in the sense that I had a commodities background, and I was young and dumb enough not to understand cyclicality. So I was extremely aggressive in a market that worked well. Like many young men, I confused a bull market with brains. I thought my increase in fortune had to do with my hard work and mental acuity. That was not true. It had to do with the fact that the wind was at my sails. I did not know enough to understand the cyclicality of resources. And given the fact that the resource narrative was playing out so well in terms of price performance, I, like most investors in the world at that point in time, thought that that current set of circumstances would extend ad nauseum. When the markets worked, when the very high prices for resources increased supply and reduced demand, and the markets cracked, I was wholly unprepared for it. To the extent that in 1982, I remember personally that my goal for the year on February 3rd, which was my birthday, was to get myself back to broke. I figured if I could just be at zero, that my earnings capability was such that I could get through. And in fact, I was able to do that. It was a wonderful lesson. And it was a lesson that happened early in my career so that I could employ it for the rest of my career. And in retrospect, although it was extremely unpleasant, it was probably the way that I became the determined contrarian that I have become today. There's no way better to emphasize the cyclicality in natural resource businesses than to become very wealthy as a young man, then have all of the money and all of the hubris associated with making the money taken away quickly and violently, and having to work one's way back to broke, then to solvent, and then to rich again. Although I hope I never repeat the process, and I'm highly certain that I never will, it was a very useful, if painful, lesson.
In our last interview, we discussed your outlook for uranium and PGMs, as well as the power of warrants in junior investing. Today I want to discuss optionality. But before I throw out a specific example, can you explain what an asset's optionality is to the price of gold for our listeners?
Sure. If you have a deposit, and by the way, several great companies were built this way, Silver Standard, Pan American Silver, several great companies have been built this way. If you have a period of time where the sales price of a commodity is substantially below the production cost, which is a different way of saying if you have a point in time when the industry is in liquidation, what you know as a speculator is two things. Either the price of the commodity will rise or the commodity will become unavailable. And it's interesting that the risks involved in commodity speculation, if you have cash and courage, are actually lower when the industries are in liquidation than they are when the industries are solvent. And armed with that knowledge, what we've been able to do several times in the gold cycle is find assets in pricing circumstances where the industry wasn't earning its cost of capital. In other words, where the gold price had to rise. Assets that weren't economic at the current gold price, but could become highly economic at higher gold prices. And as a consequence of that, we were able to buy assets based on the then current price of gold and enjoy what is in fact a free option on higher gold prices. It's interesting that in the gold mining industry that we do something very strange. We take a whole bunch of gold, very safely stored in micron-sized particles in a hole in the ground called a mine, and we spend a whole bunch of money and we, quote, beneficiate that gold and put it in a hole in the ground called a vault. And there is a school of thought, which I subscribe to, that says that if you believe in higher gold prices, that the right thing to do is buy a lot of gold in the ground, pre-mined, and do nothing, do absolutely nothing. And then when the gold price rises, sell that gold in the ground to someone who is going to beneficiate it. Doing nothing is something that's very difficult for most people. Doing nothing for 5 or 6 years is something that's very difficult for most people. But as recently as 3 years ago, Warren Buffett said that in his 80s, he has come to look for and favor tasks that require of him sloth and lethargy. And I'm increasingly drawn myself to the idea that I should look for tasks that require, at age 60, things like sloth and lethargy, which I seem to have in abundance. So the whole concept of this optionality is attractive to me. If, as an example, with the gold price currently at $1,200, you look at a deposit where the operating costs are $1,000 an ounce, where the sustaining capital cost would be $100 an ounce, and where the upfront capital cost to put the thing in production would be $200 an ounce, as an example. In other words, a deposit where you'd sell the stuff for $1,200 an ounce and it would cost you $1,300 or $1,350 an ounce before G&A to put the thing in production. That deposit has no net present value to an operator, none whatsoever. The net present value of that deposit at current gold prices is negative. It is possible in the right set of circumstances, if the owner of that deposit needs money, to buy a deposit that they spent $70 or $80 million drilling and developing for, let's say, $2 or $3 or $4 million, $2, $3, $4 an ounce. If the gold price returned to some number like $1,600, $1,700, or $2,000, that deposit might be worth, in situ, sitting in the ground, $100 an ounce. Optionality is the arbitrage between what you have to pay for a deposit that is uneconomic at current prices in a market where that price changes, where the commodity price changes, and where the outlook associated with the equity values change substantially. And those numbers can be truly spectacular.
I want to bring up a specific example, a story that many of our listeners are familiar with. That's International Tower Hill Mines. If you don't mind touching on a specific stock,
Happy.
Tower Hill was trading around $10 just a couple years ago, and now trading between 40 and 50 cents a share. They have 20 million ounces in the ground, $20 million of cash in the bank, which means their gold's selling for roughly $1 per ounce in the ground. I understand it's a low-grade deposit. It's not going to be a mine anytime soon, but talk to me about the optionality on a company that's so out of the money like that.
The risks associated with things like Tower Hill, Exeter, the other junior names that are optionality names, is what I call the falling knife syndrome. What you have to do in a situation like that is nothing. And it's difficult for most management teams to do nothing because getting paid large salaries for doing nothing is a difficult thing to do. I'm not talking specifically about Tower Hill or Exeter, But what one needs to do is find those optionality packages wrapped up with management teams that are willing to thank and excuse, which is a different way of saying laying off most of their peers. Part of optionality has to do with preserving the value of the deposit by preserving the cash in the treasury so that the company can stay alive without additional equity dilution. And so in terms of considering an optionality play, a public optionality play like Exeter or like International Tower Hill, one must look very carefully at what the general and administrative charges are associated with the company and whether or not the management team intends to, quote, beneficiate the deposit, which is a different way of spending money on a deposit, which doesn't require any money spent on it for optionality. It's very, very, very true that mostly in bad markets, the only thing that a management team can do to an optionality project is make them worse by spending money. It's very important, therefore, as an optionality speculator, that you pay attention to rapidly declining general and administrative charges. If the general and administrative charges stay the same, you need to understand that the management team is fashioning a wealth transfer from you as shareholders to them as promoters.
I guess what I'm getting at is that there are two different investment strategies at this point in the market. One is buying into a deposit that's high grade and can be a mine in the near future, even at $1,200 an ounce. The other is buying into an optionality play. Do you suggest a dual strategy, and what are you employing personally at this point in the market?
I definitely suggest a dual strategy. The net present value of a deposit which is economic today, can be put into production today, and can generate free cash today is higher than an optionality deposit. I believe in higher commodity prices. I believe in higher commodity prices for a couple of reasons. One, I believe that the denominator, the US dollar, will decline in terms of purchasing power, which will make the nominal price of precious metals higher. I also believe that the whole thesis behind the natural resource and precious metals bull market is intact. And so my own point of view is that the gold price 5 years from now or 6 years from now, the precious metals prices, in fact, generally, will be higher, perhaps dramatically higher than they are today. So for part of my portfolio, that part of my portfolio which is determinedly speculative, which is a large part of my own personal portfolio, a proposition where I could put up $100,000 with a binary 5-year outcome. One, that the $100,000 would go to zero or $20,000 or some number like that. Or two, where the $100,000 could go to $2 million or $2.5 million is very, very, very attractive to me. If I put up $100,000 and lost the $100,000 over 5 years, it would not change my decision as to how to live my life. But turning $100,000 into $2.5 million would make a much larger difference than losing the initial $100,000. Your listeners who are in that position with some small part of their net worth need to consider optionality because it's a better speculative strategy than net present value investing is. It's not an investing strategy, it's a speculative strategy.
I was listening to an interview with Eric Sprott a couple weeks back, and he pointed out that the HUI rose about 17 times from 2001 to 2007. Now that's a weighted index, and many of the smaller companies rose much further than 17 times. Include a strategy of investing in private placements to accumulate warrants, and the potential for a bubble phase in gold, and we're set up for truly spectacular gains. Am I correct?
That's correct. I mean, my own experience in the 1998 to 2003 bear market was almost perfect. It happened at a point in time when I had the cash, the experience, and the reputation to take really perfect advantage of it. I understood, as a consequence of having been through 3 cycles prior to that, that bear markets are the authors of bull markets, and the product of the very dismal market conditions that existed in 1998, 1999, and 2000 was going to be a bull market of epic proportion. The consequence of that is that I was able to deploy capital that I had and capital that I could attract in a market where nobody else was a capital provider. I was able to buy companies that were in the top decile, or at least top quartile, of junior resource companies. And as a consequence of the fact that I had no competition in terms of providing capital, I was able to deploy capital fairly with a full warrant. And one thing is that if you deploy capital in reasonable companies at market bottoms, it is reasonable to expect five-fold, six-fold, or 10-fold, or 15-fold returns. If you enjoy a 15-fold return with a full warrant, it's much more likely that you're going to enjoy a 20 or 25-fold return. It doesn't take an awful lot of 25-fold returns to amortize the failure elsewhere in a speculative portfolio. The truth is that one must acknowledge that these markets are extremely, extremely cyclical and extremely volatile. And you either use that volatility and cyclicality to your advantage, or you get used by it. Therefore, my slogan, repeated 1,000 times in conferences around the world, in resources, you are either a contrarian or you are a victim. The market that we're in right now, which scares people, as an example, where the TSXV has fallen by 75%, suggests to people who are not arithmetically challenged that the market is precisely 75% less risky arithmetically. The point that you make with regards to Eric Sprott was brought home in a personal conversation that I had with Eric, where we were talking about our own investment performance over time. And he said, listen, no matter how good you are, if you believe in yourself and you believe in your management teams, that portion of your speculative portfolio that you don't sell in epic bull markets will cost you 50% or 60% on the downside. That's the way it works. That's the bad news. The good news is, in a recovery, you will make 5 or 7 or 10 times your money. So if you think through decade-long math where you give back half and then you make 6 or 7 times, the aggregate math over a 10-year period of time, particularly if it's amplified by warrants, which cost you nothing on the downside and make you a fortune on the upside, is very, very, very attractive.
I know you're very tight-lipped on giving out any stock recommendations, but I'm going to try and get a few out of you here. The last recommendation you gave was around October for Uranium Participation Corp, and that's already up around 15%. Can you give anything else to us at this point?
Well, I still believe Uranium Participation Corp is a decent speculation. It's not as good as it was then because it's selling at a small premium to net asset value. I love buying things on sale. But I do believe that given that it costs the industry worldwide $70 or $75 a pound to make uranium, and they sell it for $35 a pound, I mean, imagine that business, right? You make something for $75, you sell it for $35, and you try and make it up on volume. I mean, we have two choices, I think, in uranium. Either the price goes up or the lights go out. It might take 3 or 4 years for that to happen, but from where I sit, a 3 or 4 year double is not a very bad thing. So that's certainly something to look at. I need to say, and this is very self-serving because I own a bunch of it, that the stock of my employer, Sprott Inc., looks relatively attractive to me. It pays a 4% dividend. My friend Doug Casey describes dividends paid from free cash as outward manifestations of inward grace. And I would describe us as being fairly graceful. We have $340 million in working capital. We have no debt. We have won recent investment mandates with National Pension Services of Korea, Korea Electric Power, and Zijin Mining. We have over $1 billion in fresh capital to deploy at the bottom of a bear market, and the performance fees that we could earn on that capital, if passed as prologue, which I believe it is, are pretty spectacular. So that's something that people could look at. You could think of us as a proxy for the natural resource business, and a solvent proxy, a non-capital intensive proxy for the natural resources business. I think that's a reasonably attractive set of circumstances. There is a closed-end trust that trades on the New York Stock Exchange for the more investment-minded of your listeners called Petroleum and Resources. It's been in existence for about 40 years. It sells at an 8 or 9% discount to net asset value, and most of its net asset value is made up of the largest mining and oil and gas companies of the world. I believe that the natural resource thesis is intact, and I believe that the shares of these supergiant commodity producers will rise over 5 years. And owning a relatively stable portfolio that will rise over 5 years at an 8 or 9% discount to net asset value is certainly an attractive proposition too. I would leave you with one other general comment with regards to recommendations, and that is for American investors, particularly investors in the West and the Southwest. Those investors who don't, in the next 12 months, get themselves involved in the water business will be making a mistake. Water is the most mispriced asset in the United States, and it looks as though we are entering a period of systemic droughts in the West and the Southwest. Investors who live in the West and Southwest would be advised to buy water stocks simply as a hedge against their own cost of living, in addition to it being a speculation. And so I'll leave that as a sort of a contrarian opportunity that people haven't looked at, that they should look at unless they live in the West and the Southwest, in which case they must look at it.
And can you provide any example of how an investor would look to buy into
I,
water?
I would prefer not to do that. There are three names in the water business, and for want of a desperately bad pun, they are highly illiquid. And I have noticed if I give a recommendation on a program like yours that has 6 or 7 or 8,000 participants, that what happens in the 4 or 5 weeks after the presentation is I have something called presentation frenzy, which is where 6 or 8,000 fairly wealthy people compete with each other to exercise the idea in the market. And ideas that are illiquid generate a run-up in price that's completely unwarranted. And it inures to my detriment, to your detriment, and to the speculators' detriment. This is also a way, of course, of trying to attract your listeners to doing business with us. But we're happy to provide the names of companies that we have invested in on a one-off basis where people are willing to use a good till cancel limit order to buy the stocks as opposed to participate in a common frenzy.
Very well. Anything else you'd like to add for our listeners?
Only thank you very much for the opportunity to address your audience again. I enjoy the process. I particularly enjoy the range of questions that you asked me with regards to optionality, because I think it's a particularly well-timed discussion. Nobody wants to be involved in the concept that the gold price might be higher 2 or 3 years from now. And as a consequence of that, the competition for an idea that would benefit from a set of circumstances that nobody believes will come true is extremely small, which is precisely where big amounts of money are made.
Well, Rick, thanks so much for your time, and we'll have to catch back up with you again in a couple months, hopefully at some higher gold and uranium prices.
I look forward to it.